Hi, good afternoon, everybody, and welcome to the Tobias Financial Advisors investment webinar today. We're just having a few more folks log on to our presentation right now, so we'll give it about one more moment and we'll get started. All right, let's get into this today. So thanks again for joining us today. You should be seeing our screens here today. I have some slides. I have a lot of. Hopefully, you're a visual learner. I'm a slide and picture person, so I have lots of charts to share today as we go through a bit of a recap of last quarter's returns, as well as kind of some forecasts and outlook as to what we're going to see moving forward into 2021. So let's get right into it. First, of course, this is our general presentation. This is meant for an audience of all types of different investors. Could be conservative, aggressive, younger, longer time horizon, you name it. So this is more general information at heart. And if you do have specific questions about your portfolio or how you're invested, please contact your advisor here at Tobias Financial Advisors. And additionally, if you're not a client currently, would like to offer you kind of a portfolio review, a complimentary portfolio review to anyone that would like to have a second set of eyes on their portfolio. We do offer these as a get to know you a little bit better and see how you're positioned in your own personal portfolio. Just some general information about Tobias Financial Advisors, founded in 1980. We currently manage $500 million in investment assets for our clients. We have a team of experienced professionals. We have a chartered financial analyst, CFP. I forgot to introduce myself. My name is Matt Sainholtz. I am the Chief Investment Officer here at Tobias Financial Advisor. I am a chartered financial analyst, a certified financial planner, and a co-owner of our firm. I've been with our firm for, let's see, over 15 years at this point. And so we have a very well-versed and well-experienced team that services our broad client base, mostly private individuals. We do have some 401k plans that we help manage and advise on, but most of the time we're helping people like yourselves achieve their financial goals into retirement and beyond. You know, a little bit about our overall general philosophy. I think 2020 was probably definitely the year that we know that we can't control everything. You cannot control everything. There's no one person that can predict the future and be reliable to make a futures guess on which way the market's going to turn. So, you know, it's really remarkable. What we do want to do is control what we can control. So with every client, we create an investment policy statement. This sets forth how we're going to invest your assets, give them some general parameters of how aggressive we would like to be with your assets. So, you know, we want to definitely document how we're going to invest your assets. We're going to broadly diversify amongst all different types of asset classes, whether that be fixed income or bonds, stocks or equities, as we sometimes refer them, small cap, large cap, international, emerging markets, all across the board. We want to diversify globally. We want to reduce our expenses. We don't want to overpay for investment exposure. We don't want to create a lot of turnover in our portfolios, and ultimately we want to minimize taxes. So we want to be able to keep, you know, we want to keep our hard-earned investment returns and not give too much back to Uncle Sam, especially if we don't have to. So that's just a little bit about our just investing tenets and principles. So today's agenda, really just a recap of 2020, what we saw, what happened as far as fourth quarter and 2020 investment results. And then we're going to tackle a few questions that we're hearing from some of our clients. You know, what's going to happen in the global economy in 2021? What are the forecasts? You know, stock markets are again at all-time highs. You know, what are some thoughts around that? Low interest rates, fixed income, And as a matter of housekeeping, in your webinar tool, there is a way to send in questions. So if you do have a question, please type in your question into the webinar tool. We'll do our best to get to it today. But if we run out of time, myself or someone on our team will definitely reach out and make sure that we do our best to answer any questions that you may have. So without further ado, what happened fourth quarter 2020? Very great, very strong fourth quarter this past 3 months ending December 31st, 2020. We had the U.S. stock market up almost 15% in those 3 months, followed by actually leading the charge was the emerging market stocks. Emerging markets are companies headquartered outside of developed international markets. So these are traditionally Brazil, China, Russia, India, some smaller emerging economies. Those have actually did the best in the fourth quarter. Fixed income bonds were up about half a percentage point, and really just a strong quarter through and through. As you'll see, in my next chart, which I'll just go to right now. This I warned you right now. There is a lot of information on this chart, and I'm happy to. We're happy to provide these slides so you can take a little bit more time to dive deep. What happened at the end of the fourth quarter to drive some of this great performance? Of course, we had a presidential election that here in the U.S. that, well, let's just say that we're through it, and it did create a little bit less uncertainty. There's still uncertainty, but there's a little bit less uncertainty after all said and done. The markets ended up and didn't think that there would be too much change. This is my estimation, too much change into some of the policies. We had basically still a divided government, and then we subsequently had the Georgia runoffs, but at the same time, we know nothing too drastic or extreme happened in the presidential election. I guess that's from where you sit. But back to this a lot of information. This is the chart. The blue line is the S&P 500. The various headlines across the board throughout 2020. If we look back in January 2020, that was actually the first diagnosed COVID-19 case in the United States. Fast forward to November when Johns Hopkins reported 11 million cases of COVID. And of course, unfortunately, that number is still climbing today. Into March, at the bottom of the blue line here, we had a 34% from below the peak in the S&P 500. This actually was about at the same time when the Senate first approved one of the first stimulus packages. So we've seen the down. And then we saw the up. We saw about on August, S&P 500 recovered 173 days later. So about 6 months later from the very low, it was very, very nerve-wracking time back in March and April, but the bottom of March, about 173 days later, the S&P 500 was back up to the February 19th levels, which were the highs at that time. So since then, we've taken out those highs and we've continued to march higher. The interesting part about the blower part about this chart is kind of it's a very colorful indication of what was flowing in the money markets at that time. So what was getting out of the markets and going to a flight to safety. You can see the green just is a huge peak of money flowing into money markets. This was just in March where it was just, there was a lot of fear, uncertainty, you name it. Nobody knew what was going to happen next. The economies across the globe are shutting down. People were just rushing for safety, and you see this big spike coincidentally coinciding with the market lows of people rushing out of the markets. And we've seen still a lot of money on the sidelines. We've seen some of it come back, but that's what happened in the past, and we've seen obviously the election go by, the presidential election. We haven't seen the reverse of the money markets flowing back into the stock markets. But we'll talk about a little bit about that with cash on the sidelines and what that means for personal investors and potentially what the market overall in general. So S&P 500 We had a very distinct year. We had very diverse. So you can see this chart, the S&P 500, which is the U.S. stock market generally, was up little over 18%, and this kind of goes through each of the different sectors. So maybe not surprisingly, from a work at home standpoint, we have the information technology firms are up over or close to 44% just in the calendar year 2020. Contrast that with energy, typically the big oil companies, less demand, less travel, less shipping, economy just in a very tough period. So that is basically the biggest dispersion between sectors in one year that we've ever seen, and that is really remarkable. And you can kind of also see that some of the growth-oriented stocks, the technology stocks, did a bit better than the value stocks, which is traditionally the banks, and some of the more cyclical sectors are kind of in that value side of the coin, and we saw a big heavy year for large company growth stocks, and those have performed very well. And we're going to be talking about whether we see that potential performance persisting or not, and we're going to dive into that just here in a little bit. But it's really amazing just to kind of see the discrepancy, and just to think back at that previous slide about all the different headlines that we witnessed through 2020, and that from a financial standpoint, from the market standpoint, that we have recovered in the stock markets and then some. And it's just one of our tried and true stories here is that we stick to our investment plan. We make adjustments as needed, but to call the markets ups and downs and learn to get in and get out at the right time is next to impossible. So we want to build that diverse portfolio, which we'll continue to talk about as we move forward here. A lot going on in this chart as well, but that was the S&P 500 up 18%, and this is 2020 returns across the globe. Europe, Asia, Far East, developed countries returned 8%. Europe, without the UK, was up 11%. Emerging markets were at about 18%, and that's kind of part of China. China was one of the first countries to have the COVID-19, and they with some of their policies, they were able to lock down the country even faster. We may be able to quarantine and kind of get a hold of this virus a little bit quicker. It was quicker to reopen their economy. So actually, China here on this chart here was actually one of these selected countries, up almost 30% in 2020. That is one of the leading countries in the globe, across the globe, for calendar year 2020. Top right here, our pie chart. The United States accounts for about 57% of the world's stocks. That leaves 43% for countries that are headquartered across the globe. One of our major tenets here at Tobias Financial Advisors is to invest globally. It is a global economy, and so we don't want to, just as China had the biggest performance in 2020, we don't want to shut ourselves out to that. And so again, a diversified portfolio, and there's going to, at certain points, there'll be leaders and laggards, and I think international is going to be a bigger component of returns over the next 10 years, and we'll talk about a little bit more why that might be. Before we move on this bottom right slide here, you can kind of see technology versus cyclical sectors. So technology, in the S&P 500, has a larger weighting than if you compare that technology weighting to other parts of the globe. So in other words, U.S. is heavily weighted towards technology. We just saw that technology had one of its best years of all time and was a leader in 2020 compared to other sectors. So that really benefited large tech companies in the U.S. As the world comes back on the line, as we're becoming more cyclical, we do think that other sectors and other regions, maybe not so reliant on technology, will kind of have a rotation, and the U.S. large companies' technology may not lead as much. as we kind of rotate the leadership in the markets. What clients are asking? All right, so our first question of the day, what is the economic outlook for 2021? So this is a kind of a snapshot of where we were and then what we've experienced, and then we'll kind of talk about some kind of forward-looking approaches. But you can see the trend growth in the United States was the 2.5% growth. And what we experienced, actually, it was more record-breaking data here from 2020. We experienced the best of times and the worst of times. So in the second quarter of 2020, we had a negative 31% quarter-to-quarter downturn, and one of the worst quarters actually ever. Even in the Great Depression, we didn't see a quarter like that, where we just have such negative growth, and that is a result of shutting down the economy. And vice versa, when we started to open up a little bit last summer into the third quarter, we actually had the country's best performing quarter, up 33%. So again, just miraculous numbers, huge swings. Going forward, we want to try to get back to that trend line of at least 2.5%. We've had a good run. We're not quite all the way back yet. What's going to drive us? What's going to drive that growth going forward? And this data here kind of paints a picture of what I think is going to happen with this is basically pent up demand. Think about your own personal situation. Think about your family members who haven't been able to travel to see each other, let alone for business, just to see each other for quite some time. Families with the stay-at-home orders have been pretty well stayed put. Business travel has been down. This chart here is a lot of data here, but each of these line items represents a different part of the economy, kind of high frequency data, kind of gives us some information on what's happening real time in the data and the economy. I'm just going to pick one. TSA traveler traffic, at the very worst, it was down 96%. You can see how the world just kind of shut down here back in March. And currently, we're still only about a little less than half of where we were prior to COVID as far as U.S. travelers traffic. Diners are still down. Going to restaurants, probably not the top of people's priorities. They even have data versus on your GPS. Yes, there's data everywhere. Data on the GPS still not quite there. What has been there is mortgage refinancing as a function of course, the low interest rates. And consumer and credit card, debit card transactions were almost back to normal there. But the point is, once the vaccinations, let's hope that what we're seeing and hearing is from some of our leaders of how quickly we're going to be vaccinated. The base case scenario is that we're going to be vaccinated by most of the people that want to be vaccinated will be vaccinated by summer or late summer, depending on, there's all sorts of predictions, but at some point in mid 2021, we're hoping to see some vaccinations, and that is going to unleash some of this pent up demand. The U.S. travel market will come back. People will go out to dinner. I'm taking my kids to Disney. It's going to be a blast. But we're going to have some spending come back in the economy, which is why we think, from the market perspective and the economic perspective, we will see a slow progression towards getting back to the pre-COVID-19 trend line. So this is from our friends at Vanguard. This data here, you can kind of see that pre-COVID-19 trend on the GDP, the baseline scenario of kind of getting back to work. Maybe not back to work, but having a lot of vaccinations out into the economy and the public by mid 2021. You can kind of see that by December 2021, we kind of get almost back to where we were pre-COVID from a growth perspective, and then out into 2021, reaching back to pre-pandemic levels. So that's kind of the base case. On the upside, of course, what things could happen on the upside? Well, faster vaccination rollout, other things that could just help the economy spur along, greater pent-up demand than we could even think of. On the downside, it's really the year of health. The downside is the vaccinations aren't efficient as we might like them. We see the next strand come in, those sorts of things. So, but of course, we could even have the stimulus. We're hearing stimulus out of Washington. That's also going to play a role of keeping this economy going and getting us back to pre-pandemic levels. So, we're cautiously optimistic. We think that, we hear all sorts of numbers. You hear Biden, 100 million vaccinations in the first, few months of office. We've heard, 200 million people will have the vaccination by this summer. We're hearing all sorts of different estimates, but it's moving in the right direction. And that's what the market's pricing in. That's what's being expected. We'll get a downside. We'll get the volatility. We'll have pullbacks if something that we don't expect happens. But right now, we assume the market's pricing in that the world will get back online at some point in 2021, whether that's summer, whether that's the end of 2021, we're not sure. But that means we think we will have some positive economic growth into the next 12 months and probably into 2022 as well. So you look at the S&P 500, we're at all-time highs even during the middle of a pandemic. So our stock's expensive. This is a good time to be buying. So there's a couple of different metrics you could think about. Relative to what? What are stocks expensive to? And when you think about the bond market, stocks don't appear to be historically that expensive to where bonds are. And that's probably more of a function of bonds being pretty expensive, where people are clamoring over themselves to buy really low rate bonds and buying bonds 10 years out. The U.S. government right now is issuing bonds that pay off in 10 years for just over 1%. So when bond rates are so low, that means prices are that high. So relative to bonds, you can kind of see over time, stocks are not too pricey relative to bonds, and we look to keep a good balance between the two. So on one hand, we're going to say no, they're not. They are pricey. Valuations are on the higher end. Don't get me wrong, and I'll show you that just here in a second. But relative to bonds, I still think that equities have a place in the portfolio, of course, and could be a point where we could have a good point to invest in those as well. But let me move on to the next slide here, where we have I'm gonna have to explain this for a moment, but this is basically a PE ratio, which is a measure of stock valuation. Price is on top, earnings are on the bottom. And so as I was saying, on a historical basis, comparing stocks to themselves, the S&P 500 is currently at a 22.3% price to earnings ratio over the next 12 months. On average, that's it's about 16.2 historically speaking. So yes, we are a bit overvalued historically speaking, but what's driving the valuations are the low interest rates and people putting money into the markets where there's just not a lot of great alternatives out there. So that's one way to think about it. What's even more interesting, though, to me, as an asset allocator and an investment manager, is looking at the top 10 stocks in the S&P 500. So the top 10 stocks in the S&P 500, which are just quickly Apple, Microsoft, Amazon, Facebook, Tesla, Google, Berkshire Hathaway, Johnson & Johnson, JP Morgan, and Visa. This chart is from JP Morgan, which we have the ability to show to you today. But out of those top 10 stocks, heavily weighted toward those large cap technology stocks we talked about a little bit ago. their current valuation is 33.3, where their average valuation is more along the lines of 19. And then, so you can kind of see where the gray line is of the remaining stocks. The other 490 stocks, their valuation is only at 19.7 compared to a historical average of 15.5. So what does this mean, Matt? What are you trying to say here? What I'm trying to say here is that, again, the very large companies, the very large tech stocks, they've carried this market for the last, well, some would argue 5, maybe in 10 years. But for the past few years, with technology and COVID and just the gains we've seen into the technology space, those valuations appear to be on the higher end historically. So we don't want to forget. It's easy to forget about the other 490 stocks and even small companies too, which aren't even included in the S&P 500. Those valuations are still relatively attractive to the larger companies. So when we're looking to invest money, we're not just going to buy the Apple over and over again. At some point, those companies are going to be appropriately valued or overvalued. So we want to be able to buy the rest of the 490 stocks into our investment portfolios, and then small companies as well. Again, it's kind of the technology led us during the COVID crisis. The forecast may be, well, maybe in the next 5 to 10 years, maybe technology stocks won't be the leaders. Not to say technology is going away, of course not. We have new technology every day, so it's not going anywhere. We're not trying to say that we don't want technology in our portfolios. We want to be mindful not to just chase what's been doing well the past couple of years. Very likely, what happened in the past couple of years is not going to be the same thing that leads the markets in the next couple of years from today. One of those things that we like to talk about often is also international stocks or international companies across the globe. When you look at this, basically, we'll just call this the blue line is the U.S. valuations, U.S. companies, how the stocks are valued in the U.S. compared to global companies that are headquartered abroad and their valuation. So you can see kind of in the 2000 area, the tech bubble here, U.S. was more expensive relative to the rest of the world. 2007, 2008, that was kind of flipped where international was more heavily valued. But let's look at what happened since basically the global financial recession back in 2009, even into COVID. These last 10 years, the U.S. has been done tremendously well, and we've experienced some very positive returns. But now we're thinking about, okay, where should we put money for the next 10 years? And the valuations would say, well, the U.S. is looking to be a bit pricier than the rest of the world. So we want to take a look at being a global diversified portfolio, one of our core tenets. We want to look at companies that are headquartered in the emerging economies into international. So we have some tailwinds for international stocks. It's not just valuation. Expected growth for different countries and GDP growth and is in some cases heavily favored to countries outside of the U.S. Plus, we have we have a different political regime coming in, maybe one that'll be a little bit more friendly, a little less tariff to global economy, so a little more supportive to the global economy. And I think actually COVID was a de-globalizer. We have countries working together as far as finding vaccines. The past 4 years may have been a more country first, us first mentality. And I think we're going to see that shift here back to more of a global perspective in the next few years from a political spectrum, but also from a valuation standpoint and also just expected growth. How are stocks valued? Well, stocks are growing. People are willing to pay for it. And I think that's what we're going to be seeing in the next few years. Another question we're hearing a lot about interest rates. Interest rates being so low, my bank account pays me nothing. what should I be doing with my cash? What is the role of bonds in the portfolio? I previously mentioned how low yields are in the US, but let's just see it on a graphical. So this is different types of bonds and their yields. So a 3-month here, let's look at this little, I guess call this kind of turquoise. End of the year 2020, this turquoise lines, this is the US Treasuries, this is the US government issued bond. So a 3-month, kind of the short end of the curve. This is a yield curve. We're very under 0.5% until you get out to about 5 years. And then about 10 years, you're at 1%, and even the 30-year, you're at about 1.5%. This is higher than we were earlier in September, so we have seen a little bit of rate increase into the last few months in the fourth quarter, but still very, very historically low rates, and we've seen this before, and they will likely continue to remain low. Let me just take a look at across the globe. This is a global phenomena. There's even negative interest rates. It's been that way for a few years, and I'm glad to say that it looks like our U.S. Fed is trying its best not to go into the world of negative interest rates. It just hasn't seemed to work across the pond over in Europe for negative interest rates. So U.S. is still positive, but this is all very low. This is all very low rates. Our Fed, our U.S. Fed, we expect rates to remain low. They are going to be, the Fed has come out to basically say they are going to remain low. It's going to be very supportive. The Fed's goals, a dual mandate. They want to increase, have inflation be at their benchmark, which is about over 2%, about 2% or over 2% for an extended period of time, plus full employment. And they've basically said that that low interest rates are here for at least the next couple of years, is what I read. So, again, with valuation, with these low rates, valuation in the stock markets can remain a little bit elevated, even though we have the lower rates. Due to the lower rates, we're able to have a little bit higher valuations in the stock markets. So, we want to diversify in the fixed income world just as much as we do in the stock markets. So, in the stock market, we talk about value versus growth, large or small. In the fixed income world, you don't want to just be in all U.S. government treasuries. We want to be, again, globally diversified, maybe even a little bit of higher credit or lower credit ratings, meaning a little bit more risk to the companies and the bonds that we own. And we do this all in the mixture of mutual funds and ETFs. So we're buying baskets of these, but it's just very important to not just to get so hung up on one area on the bond market. So that's our job, is to help diversify. But we do think rates are going to stay low for long. So, what does that mean in the context of a diversified portfolio? Well, yes, bonds aren't paying that much, but it's really hard to find a better diversifier that's not correlated to the stock markets than fixed income. And, why do we want fixed income? Well, as we can see here, we had 44 days in calendar year 2020, where we had a plus or minus 2% or more in the returns. That's the S&P 500. So, volatility was back last year after having a pretty lower than average volatility years from 2012 to 2019. Volatility came back with a vengeance last year, obviously due to what was going on in the economy and the world and the global pandemic. But that having that bond exposure when the markets do zig and zag, and we do see some downside, we look to sell the bonds in the portfolio. These are a stabilizer. We look to sell the bonds to buy more in the stocks, and we did that for most of our clients in 2020 during the March and April timeframe, where a lot of sectors, energy, transportation, were getting beat up. We used some of our bond allocation, and we strategically reallocated that to those stock sectors, and it turned out that it worked out really well. And that is one reason why we need to have the big fixed income in the portfolio. Another reason and this is just kind of speaks to the idea of, you know, our general philosophy, diversified portfolios. It's just a smoother ride. So this chart is great. I really love spending time with this with our clients and our client meetings. But real quick, as best as I can, the left column here is the S&P 500 dating back to the year 2000. And on the right hand is a diversified portfolio of U.S. stocks, some international stocks, small caps, emerging markets, and then about 40% in bonds or fixed income. So fast forward 20-year returns, the diversified portfolio beats the S&P 500 in all stock portfolio after 20 years. Not by much, but if you look at some of these returns, it's a much smoother ride, and it allows you to sleep at night. It allows investors to, you know, believe in the investment approach. If you look back at more recently, and just like kind of the first half and second half of 2020, during the downturn of the first half of 2020, stocks were down 30%, where the diversified portfolio was only down 20%. You know, you're not happy, you're down money on either case, but maybe you're a little bit less anxious knowing that the portfolio had some bonds, some things that weren't tied exactly to the stock markets over time, and vice versa. You know, the return was greater coming out of the bottom on the stock side of things, but you know, it just goes back to staying invested, investing for your goals, and making sure that your portfolio allows you to sleep at night, as well as hopefully gaining that growth year after year over time. So that is why, even though as rates are so low, we want to continue to invest in fixed income. And if you have a lot of cash on the sidelines, we'd be happy to talk to you about some different avenues. Of course, you want some cash for your emergency fund, but at this point, with the cash being such a basically returning zero, and the Fed pushing inflation, wanting it to get to at least 2%, keeping too much cash is actually a detriment to your long-term financial goals. So, well, just to wrap up on a few points of optimism and a few points of caution, you know, 2020 told us anything that I'm not going to try to sit here and predict the future for you, but we are going to try to tilt ourselves into better outcomes by you know, thinking about what could increase our baseline of getting back to normal sometime in 2021 or 22. Vaccination nation, new approvals of different vaccinations. You know, you read about one-shot vaccinations that have to oppose this too. You know, having that pent-up demand unleashed into the economy, into the world at some point in 21 should help maintain the economy as well as drive markets forward. Second point, government stimulus. Biden has put out his plans to continue to support our nation's citizens in various ways, whether that be direct payments or other supportive measures. You know, this is happening at home and abroad. Globally, we're pushing money into the economy. At some point, that'll probably come home to roost, but we don't think 2021 is going to be that year. This is still a year of getting out of the pandemic and getting back to a recovery of some form and fashion. Same thing with the low interest rates. It's providing housing, you know, mortgages. If anyone in your family or yourself has been trying to move recently, you know that real estate is pretty hot, and that's driven by the low interest rates out there. And companies are the same. You know, we're seeing mergers, acquisitions, different financing projects due to the low interest rates. And you know, one of the things that's happening out there also is that we're starting to see a little bit of a weaker dollar. And you know, it's not on the surface that might sound pessimistic, but it's not negative, or especially when you have a global portfolio. Typically, when there's a weaker dollar, your international emerging markets and commodities do well. Sometimes gold as well does well in a portfolio where we have a weaker dollar. So I think having that approach will be points of optimism for a globally diversified portfolio and markets abroad. Government support, low rates, vaccinations, pent-up demand. I'm pretty optimistic about 2021 from an economic perspective. Not to get ahead of ourselves here, the points of caution. Obviously, COVID is the biggest wild card question mark out there. Whether we see some really nasty second strains come out, or we have to shut down the economy again, that would be obviously a detriment to our base case outlook. Inflation, we're going to start to hear a bit more about inflation. It hasn't been a major factor in recent years, but with all this low interest rates and government stimulus, with potentially less goods out there and more money chasing it, you could lead to some higher inflation. But that's why we are invested in stocks. We do have in some of our portfolios a commodity sleeve, and we're gearing up to have and be ready for some inflation. And this inflation, unfortunately, could lead to the higher rates. Again, the Fed's going to probably do its best to keep rates low. And so, kind of still see that approach, but higher inflation could lead to higher interest rates, but could be a detriment to not only stock valuations, but also bond valuations. Other headwinds would be significant changes to the tax code. Yes, we could see some tax changes. I don't see it happening for 2021. Maybe something gets passed for 2022. I think everyone, a lot of our policymakers and our Fed and our business leaders, we want to get out of the pandemic first before we put the brakes on it. And campaign promises aside, I think that we will likely not see major tax rate increases for 2021. We will. We're going to keep our pulse on it, but at some point we may see some tax rate increases, but maybe not for 2021. And the last bullet point is kind of political and social. If we, for some reason, do not have a smooth transition of power from a presidential transition, and or just general social unrest, we could do a whole different webinar on wealth inequality and how today compares, what the haves versus the have-nots have compared to today, compared to 50 years ago. But if some of that wealth inequality spills out into the form of protests and disrupting our social norms, that would be something of concern for the economy as well. So, thanks for joining us today. I do have, looks like one bonus question here. The bonus question for today is about virtual currencies, Bitcoin. You might have heard of Bitcoin. There's different levels of what virtual currency is or is not, and what blockchain technology is versus what Bitcoin really is. Again, we probably will at some point, and we probably don't have enough time to really do cryptocurrency justice today. I would just say that I remember 2 years ago when we were doing one of these presentations, and Bitcoin was at 20,000 the first time around, and then the very next year was down to about 5,000. In 2020, with the potential for inflation, some folks on Wall Street and across the globe are looking at this as a kind of a digital gold, an inflationary hedge. And that is why you're seeing demand for Bitcoin, which is a digital currency, it's more about a supply and demand. People want it, and so you see that the market has increased. The scary part to me is how you value it. If there's no earnings, this doesn't pay a dividend. It's really hard to come up with a value for this digital currency that's really not backed by much of anything. We will start to see digital currencies from countries, the Euro Union, the Euro, that seems to be on track for a digital euro, a Chinese yuan. Seems to be some digital there as well. So we're going to be going in that direction as global economy. I do think that'll just be kind of natural from where technology is taking us. But as far as Bitcoin, we're not actively recommending that for our clients' portfolios. It is very speculative at the moment. In the last week, it hit $40,000, down 20%, down to 32,000 per Bitcoin, and then I'm not sure where it is today, but I think it had a little bit of recovery. It's just very volatile. Not sure what it's definitely based upon, and yet, people use Bitcoin as a general term for cryptocurrency, but there's actually hundreds of them. There's hundreds of Bitcoins out there. So, why do we think that Bitcoin is going to be the leader out of all these different hundreds of digital currencies, in addition to governments having their opportunity to create their own or create a virtual currency that is government backed? So, with the jury's out, we're going to continue to monitor digital currencies, Bitcoins, and we'll see where that takes us over time. But just tread lightly, be careful. It's highly speculative investment at this point in Bitcoin specifically. Well, thanks everyone for joining us today. Again, as we said early on, if you have any specific questions for the Tobias Financial Advisors team, please do reach out to us. It's been a pleasure. We wish you and your family a safe and healthy 2021. And please do reach out to us at any point if we can provide you with any assistance. Thank you. Have a great day.